What's your name? The Russia company girl. I don't want to call you the Russia company girl. What's your name again? What's your name? Sophia. What's your name? Yara. Yara? Sophia, Yara. Then you? Okay, folks. Time for the party to begin. I promised you last session that every session, we're going to start the session with what? A start of the class test about things you won't see till the session, right? You're going to be okay, even if you've not seen it before. So today's class, I want to start with this issue of consistency. I mean, you think of a discounted cash flow model, think of cash flows and discount rate, obviously. But one of the first rules in valuation is you have to be internally consistent. You tell me how you estimate the cash flows, I'll tell you how to come up with the discount rate. So I'm going to set the table. I'm going to start a business and I'm going to raise equity from you guys. How do I raise equity? Maybe I issue shares to you or your VCs. I raise equity from you. I'm going to borrow money from you guys. You're a bank and I borrow money from you. I take the capital, I start the business. I start generating cash flows. Business is working. Who gets first claim on the cash flows? They do, right? Interest and principal payments. And if there is anything left over, is there a guarantee that there'll be something left over? Not necessarily, but no, if there's anything left over, I could choose to give it to you. I could hold it in the company as cash. So you get cash flows from the business, you get cash flows from the business. I want you to keep your focus on that. The first way to do valuation I don't even know what that meant, but I'm afraid to figure it out. Okay. Meeting audio might not be fully recorded. Okay. If it isn't, they can watch a mute session. Okay. So the first way to approach valuation is you look at everything through the equity investor's eyes. So you guys are the equity investors, right? What do you get as cash flows? Whatever's left over. And to discount them, what do you need to use? A rate of return that reflects how much risk you see in the equity. For generic terms, let's call it the cost of equity. We haven't dealt with the details, but if you have cash flows to equity, you discount at the cost of equity. What do you get as a present value is the value of equity in the business. Now, if it's a publicly traded company, technically speaking, what's the only cash flow you get to see? The tangible cash flow as equity investors. What's the only thing? There it is. Publicly traded company, equity investors. What's the only tangible cash flow you see? I heard somebody say dividends, right? The dividend discount model is a special case of an equity valuation model. Why special? Because we know companies don't pay out what they can always. But if you trust the dividends, you discount them, you're staying with an equity valuation model. But there's another way to do valuation that requires you to almost intuitively make a leap, which is, I started a business. I got capital from both of you, right? Equity investors and lenders. I'm going to value the firm, which is both of you put together. What does that mean? I'm going to look at the collective cash flows you get from the business, which is not just the cash flow to equity, but what are the cash flows you get as lenders from me? Interest payments, principal payments. That collective cash flow is called free cash flow to the firm. It's a pre-debt cash flow because lenders now are part of the process. If that is the cash flow I'm discounting, is that cash flow coming to both of you? I can no longer just use the cost of equity, right? Which is what you wanted. I've got to bring in what you demanded as a cost, which for a banker is going to be the interest rate you set, the cost of debt. Maybe I'll tweak it for some tax benefits I get when I make interest payments. But I have to discount the cash flows at a weighted average of my cost of equity and in this case, the after-tax cost. Weighted by what? How much money I get from each of you. If I get 80% from you and 20% from them, I take away. Now, you've taken a foundations class. Some of you have taken a corporate finance class. What is this weighted average of cost of equity and cost of debt? What do we call it? In this class, let's not call it the WACC. It sounds so crude. Let's call it the cost of capital, right? I know the WACC is what is the weighted average cost of capital. We love acronyms. It's the cost of capital. So if you have cash flows, the entire firm, the discount rate has to be the cost of capital. So here's what the consistency rule says. If you have cash flows to equity, you cannot discount them at the cost of capital. You have cash flows of firm, you cannot discount. So today's class draws on an actual valuation that was done in the 1970s. There's a reason I'm going back to this. Okay? By a banker in an M&A valuation. So let me set the story here. The company called Kennecott. It was a copper mining company. Had a good year, had lots of cash. In fact, it accumulated a $600 million cash balance. And the managers were a little nervous. Nervous about what? What's one of the things that might make managers nervous about having a large cash balance in a company? I think that's a good thing, right? Yeah. That, but you invest in something, if there's inflation risk, it's going to show up as higher interest rates. So that I can protect myself against. It might disappear, but that would be a criminal activity, right? So what a Colombian gang breaks in and takes it away, or drug cartel? Yeah. Yeah, that's a good problem to wrestle with, right? Most companies don't have enough cash. You can tell where to invest. They're worried about something much more immediate, which is yeah, and then you can give it back to them. They were worried about a hostile takeover. You're saying, why would having a lot of cash make me easier to take over? Because the person taking you over can use your cash to pay for a portion of the acquisition. So the managers were a little worried about it was 20% of the value of the company. Right? So if you have a lot of cash and you don't have a good use for it and you're worried about being taken over, then the logical thing to do is give the cash back to the owners, right? That thought never even crossed their minds. What would they do? Stupid things like paying off their houses or fixing their cars. You can't allow that to happen. So they took another path. You have a lot of cash, you don't have a good use for it, you don't want to give it back to shareholders. What's the stupidest way to get rid of a lot of cash? Do a big acquisition. So they went to First Boston, at that time, the leading M&A bank on Wall Street, and they said, we have a lot of cash. We need to spend the cash. Can you help us? Try this out at Bloomingdale's. Walk in and say, I have lots of cash. You'll have lots of salespeople around because I think they work partially on commission. First Boston says, no problem. We'll find you a perfect target. And they came back with the perfect target. How perfect? They found this company called Carborundum. It's an abrasives company, basically makes sandpaper, metallic abrasives. And he said, it's a perfect company, and coincidentally, you can buy it for exactly $600 million. This might be pure coincidence. When you tell a banker how much cash you have to spend, the value of a target company will magically expand to make sure the cash disappears. And of course, First Boston, leading M&A bank, puts a valuation out because you got to justify paying the 600 billion. So this is the cash flow table. It's a very badly done cash flow table, but it's a cash flow table. It's pulled right out of the acquisition. And I'll tell you how First Boston came up with cash flows. And I want you to just remember what we talked about with consistency, because I'm going to have a singular question about what discount rate to use in these cash flows. So they're looking at Carborundum, they estimate the revenues, the operating income, they subtract our interest expenses, they came up with net income, then they added depreciation, subtract capex. Technically, basically they got to a cash flow. But somewhere in what I just described, I've also told you what kind of cash flow it is. Hold on to that thought, because my question is, which discount rate should they use to discount these cash flows? And I'm going to give you 6 different discount rates. Only one of them is right. Let's see whether you can get that nailed down. So first, you have Kennecott, the acquiring company, Carborundum, the target company, and then you'll have a merged company after you're done, right? So 3 different players. You can have a cost of equity and a cost of capital for each company. So let's start with the easy choice first. Given how I describe cash flows, remember I said start with revenues, get to operating income, subtract interest expenses, maybe even debt payments, come up with the cash flow. What kind of cash flow is that? which is cash flows to, in our terminology, cash flows to equity, right? So I've made your job simpler in this table. Which column disappears? The cost. So basically, you can remove the cost of capital column, not because it's a wrong discount rate, but because of the way you computed cash flows. Now I'm going to ask you a question that half of all M&A bankers consistently fail when I do this test on. So don't feel bad about failing if you fail. This might actually allow you to pass the interview because they don't know the right answer. You give them the right answer, they'll say, no, you can't be a banker. Whose discount rate should I use to discount the cash flow? You know what I mean by whose? Should I use the acquiring company's cost of equity? And I'll give you the logic for it. They're raising the capital, and this is cost of equity. They're raising the equity. Should I use the target company's cost of equity? Or should I use some combined company's cost of equity? You think it should be the target company? Anybody, any acquiring company people? Lisa, you think it should be the acquiring company? If you're a safe company, then every risky company is going to look valuable to you, right? Why? Because you have not. So, first rule in capital budgeting is the discount rate for a project should reflect the risk of the project, not the risk of the entity looking at the project. In fact, I think the problem is we call it cost of capital. So in your mind, what do you think? That's a cost of raising. This is not what it is. It's an opportunity cost of what you would make on investments of equivalent risk. It should be the target company's cost of equity. In half of all M&A deals, the acquiring company's discount rate is used to value the target company. In the Catholic Church, you have these sins you can go confess and it's wiped clean. There are some sins, though, I think that are, what are they called? Cardinal sins. This is beyond redemption, beyond confession. This is a sin from which there's no coming back. You think, what's the big deal? Just a discount rate? Here's the big deal. They should have used 16.5%. I'll tell you what First Boston actually used. What's the worst possible choice you can make? They use the cost of capital. This is about as far from the right answer as you can get, right? And they used to 10. What do you think happens to the present value when you use a 10.5% discount rate instead of a 16.5%? You blow up the present value. They came up with a value of 750 or 800 million. That's how they justified paying 600 million. When in fact, if you took their cash flows, you didn't even disagree with them and used the right discount rate, you'd have ended up with like 450 million. In which case, what have you done? You've advised your client to pay $150 million more than what they should have. And for this, you get deal fees? I could have asked my doorman, how much should I pay for the company? Probably got better advice. And this is First Boston, leading investment bank. I want you to remember this because there are two things that come out of this. You're going to see the people, the two guys who ran First Boston at that time, the co-heads of the M&A department, called Bruce Wasserstein and Joe Perella. Does this sound familiar? Remember the last class we talked about Lynn Broadcasting, and we had Morgan Stanley on one side, and we had Lehman Brothers on the other, and Wasserstein Perella. They founded a boutique M&A firm. Terrifying word, boutique. Now, whenever I see it, I just say higher prices. That's basically what goes with boutique. Called Wasserstein Perella. And they brought down the practice of valuation lower than it's ever been. They should have been punished, right? You know how they got punished? Dresdner Bank bought Bruce Wasserstein Perella for $2 billion. And the actual press announcement, they said it for their valuation expertise. I can't make up this stuff. There's no justice in this world. You can screw up badly and you're going to rise up the ranks. You create a boutique and somebody pays you $2 billion. I want you to remember this page because you will get intimidated sometimes because of the names on top of the page. Goldman Sachs did it. Yes, they're smart people. They wouldn't do stupid things. It's amazing how many first principle mistakes I see slip through with big names, KKR, Goldman Sachs at the top, because people are so caught up in the mechanics of what they're doing and in different people doing different things and deadlines that they sometimes don't ask that fundamental question. So I would let it rest because we're going to come back and talk about acquisition valuation in a lot more detail. So when would I ever use the combined company's cost of capital? Through the question, what cash flows do you discount at the combined company's cost of capital? It's a merger in this case. Two companies can do that, but they're two separate companies. What's the magic word that gets thrown around in mergers sometimes? That synergy. If there's truly synergy, it comes to the combined company. That is a cash flow you would discount back at the combined company's cost of capital. But the target company is the target company, the acquiring company is the acquiring company. I can't do what I call valuation alchemy. You know, heard of alchemy? Alchemy is something people have tried for hundreds of years where they try to turn everything into gold. It never works. But you see it in banking. I'm going to do alchemy. I'm going to take this terrible company and make it into a valuable company by using the wrong company's discount rate. Not that easy. So I'm going to set that aside and go back to the package where we are, where we're talking about discounted cash flow valuation. Yes, go ahead, Sophia. But let's pause there. Why do companies end up with high costs of equity? They're in a risky business or in a risky country, right? So you see where this is going, right? I am ExxonMobil. I buy Lukoil. God help me if I use ExxonMobil. Even if I do everything in dollar terms, if I use ExxonMobil's cost of capital, what am I going to find? Lukoil is an insane bargain. I lost only a few $1,000s on Lukoil. They could lose billions if they tried. And it happens all the time. People buy emerging market companies, development, using this stupid logic, right? Sounds harsh, but it is stupid logic. And it leads them into really bad places. Yeah. Is right. Okay, let's pause right there. So it's bad management. You're going to come and fix it. You're going to make it a better run company. Unfortunately, when you fix bad management, good management, the effect on risk is actually minor. Maybe you can affect the debt ratio. It's really a cash flow effect. That's called value of control. So that's what you pay for when you pay for control. And if that's what you're paying for, the question I'm going to ask is who's going to do the hard work of fixing this company? You are, right? The acquiring company. Why are you paying it to the target company? Render unto them that which is theirs. And here you seem to be giving away the store for hard work you're going to put in. These are good questions because this is the heart of M&A valuation, value of control, value of synergy. We'll come back and talk about it, but we're already starting that process. So anybody remember what a discounted cash flow, what are we trying to do in discounted cash flow valuation? We're trying to estimate of the cash flows, the intrinsic value of an asset. And we're hoping to make money because we got the intrinsic value right, price will adjust. But we talked about the limitations, right? You can find a market mistake, you can buy it, and then what's that last phase? There's got to be a correction, and that's out of your control. So if you look at the disadvantages of discounted cash flow valuation, a lot of assumptions to make. You could find everything overvalued, not be able to buy things. Then you ask, who should use discounted cash flow valuation? I'll set the table. The reason I'm going to expose you to all of the different ways of putting a number to a company is I don't want to impose on you what I think works for me. For me, I'm an investor. I value things. But you could be a trader. You could price things. And I want you to, by the end of the class, there's nothing to do with grades, pick what works for you. So with each of these approaches, I'm going to talk about what would you need for this approach to work for you. So ready? Let's start with when discounted cash flow valuation works. First, at the risk of stating the obvious, to do a discounted cash flow valuation, what do you need? You need cash flows. If you have an investment that does not generate cash flows, stop using the word value around it. For the last 15 years, the most commonly asked question, I get random emails from random people. I'm sure those people don't think of them as random. I don't know them. Okay? And I may have this I answer everything because I have no idea whether I know the person or I don't. Safest thing is to answer it. The most common question I've been asked is Bitcoin undervalued? Or is it overvalued? And the answer I give them leaves them completely dissatisfied. I say, you can't value Bitcoin. Why not? There's no cash flows. I can't value Bitcoin not because it's crypto, but if it's a currency, I can't value US dollar either. I can give you an exchange rate, which is a pricing against other currencies. I can't value it if it's a collectible. I can't value gold either. I can price it. You cannot invest in Bitcoin. You can trade it. I'm not passing judgment on you if you buy and sell it. Be a good trader. Right? So it's usable only if you're working with assets that generate cash flows. What kind of investors can use it? First, remember I said markets have to correct their mistakes, and I said there's no guarantee. I'll give you a consolation price. The longer your time horizon, the greater the chance, assuming you're right, that the correction will happen. No guarantee even if you have long time. But if you tell me you have a 6-month time horizon, my advice to you is don't do intrinsic valuation. Not because you can't value companies, but because you're not giving the market enough time to correct its mistakes. So I'm going to ask you a question. Do you have a long time horizon? We're all trained to say yes, right? Because what's your alternative? Shallow, short-term person. Who wants to be that? Every portfolio manager I talk to claims to have a long time horizon. But it's a lie. Because as a portfolio manager, your time horizon doesn't matter, right? What drives your time horizon? The time horizon of your shortest term client. So in much of portfolio management, you can tell me you have a long time horizon, but the truth is your time horizon is 6 months, a year. I can see why intrinsic valuation won't work for you. Your time horizon is too short. You're saying, who has a long time horizon? Very few people. I'll give you the legendary name, Warren Buffett, right? What is it that allowed Warren Buffett to have a long time horizon? What was the vehicle that Warren Buffett used to invest? Yeah. Berkshire. I'm glad you said the insurance company Berkshire Hathaway, because Berkshire Hathaway is one of the best insurance companies in the US, Geico, with a closed-end fund. And every insurance company is like that, but most insurance companies, the closed-end fund is run by a very average manager. But for decades, Berkshire Hathaway had a really good insurance company with the best known investor in the world running their closed-end fund. Trust me, the story is going somewhere. So Warren Buffett decided what to invest in for until 2014. I mean, since 2014, he's turned it over to Todd Combs and Ted Wexler, his successors, but he picked stocks. What money was he investing? When insurance companies get money, what is it? It's premiums, right? From selling life insurance, and what drives the cash flows from that? Actuarial tables. So they're having a tough time now with the California fires, but that's what insurance companies try to do. So cash flows are driven by the actuarial tables. And the actuarial tables don't panic on you. In 2008, in November, Warren Buffett, this is the peak of one of the worst crises we've had in the last century, bought two companies in the same week. Bank of America and Goldman Sachs bought stakes in the two companies. I mean, you go back and read the news stories about those two companies in November of 2000 in real time. The first response is, that is a really risky. And you know what? No other portfolio manager would have been able to get away doing it because their client in December said, what the heck are you doing? But Buffett was able to invest because you get the you're saying, why doesn't every insurance company take advantage? That's just half of you still have to value companies and find undervalued. But if you have a long time horizon, nurture. I mean, often you're saying, I'm an individual investor. How the heck am I going to compete with Fidelity and State Street and all those guys? You have an advantage over them. And here's what the advantage is. They have clients. Those clients set their time horizons. I can't speak for you, but I invest my money and I have only one person I've got to get on my side, which is my spouse. And I've turned off the statements from my brokerage house. It's paperless now. So she hasn't asked me about NVIDIA this week because she doesn't even know we have NVIDIA in our portfolio, and I don't plan to bring her in. I think that is so dishonest, sometimes selectively holding back the truth. I'll talk to her once NVIDIA hits 150 again. I say, you know what? We own NVIDIA. Yeah. But no, it's done well for us. But this week is going to be the advantage I have is the only person I have to essentially convince. So I can buy and hold. How long? As long as my spouse doesn't find out that you got to sell the damn thing. And I don't plan to let her find out. Time horizon. So I want you to look inward, right? Because this is nothing to do with, what other people tell you to do, what kind of time horizon. And when you start your life in investing, you have a really long time horizon, partly because you're young, you're earning an income, you don't plan to touch it. But also partly you have to worry about the fact is my job. So if you get a secure job when you're 26, this is prime long-term territory because you have income coming in, you don't need the cash flows. This is when you make the long-term bets, not when you're 63. Because mortality will catch up with you. You said 63, you say, I have a 50-year time horizon. No, you don't. Not unless you plan to be the oldest person on the face of the earth by the time this investment plays off. So that's a lot. The second is, wouldn't it be nice if you could act as the catalyst for correction? You know what I mean by that? You buy something undervalued. I said, go post on Facebook or on Twitter. Nobody listens to you. But it would be nice if you could make that change. Maybe you can get Mr. Beast. I've always wanted to meet this guy. I mean, he does some of the most insane things on the face of the earth. He has like 100 million people on YouTube. Now, maybe you can get him to say NVIDIA is cheap. Maybe the people who listen to him, right? Or Roaring Kitty. Now, you can look up Roaring Kitty to see who I'm talking about. You're saying, what is this guy talking about? But somebody with a lot of heft. You and I don't have that heft. But have you heard of Carl Icahn and Bill Ackman, all these activist investors? You know, the classic. Now, how does a Carl Icahn targeting happen? What does he do? So take Bill Ackman. What does Bill do? Oh, forget about the gift. Give money, first have to make money. So let's talk about the making money half of this equation. Okay. Before he gets on the board, he does something else. How does he get on the board? What gives him the heft? He first takes a position in a company. And then, does he stay quiet? No, he's all over the place. He's on CNBC. What is he saying? The company's badly managed. It's undervalued. That's what activist investors have as an advantage, is they can actually engineer the correction if they have enough pull to them. Right? Are you an activist investor? Well, there's a bit of a problem. You need a few $1 billion to get there. So that might be your end game, but you're not there yet. So don't do anything stupid like buying 1,000 shares of Apple and saying, I'm going to make Apple change. No, they're not even listening. So there are some investors for whom intrinsic valuation works. Let's move on. Let's talk about pricing. What is it? Pricing is also very straightforward. You attach a number to something based on what other people are paying for similar things. Right? You go on StubHub. You're doing the pricing game. You're not saying what's an intrinsic value of a seat in section 232. Yeah, who the heck knows and who the heck cares? You want to go to a game, you better pay the price. How do you know what the price is? Look at all the tickets for sale. And they they help you out, right? They break it out into amazing deals, average deals, bad deals. So and it's not rocket science. They just compare prices within a section. Say, that's a good deal. That's pricing. You buy a house. Remind me again how this works, or an apartment. A realtor shows you the apartment, then they don't do a DCF in the middle somewhere? No, okay. So they talk about how much you have to pay, and then they ask them why. They say there are 6 other apartments in the neighborhood, and this is real estate is all pricing all the time. You're essentially attaching a number. And what have you done? You've given up this faith that there's such a thing as intrinsic value. You're saying, I knows what the intrinsic value is. 80% of people in the market don't believe there is an intrinsic value. I do, but I recognize you'll never get to see it. They're pricers, they're traders. And if you look at the ingredients of pricing, first, you'd like to get something exactly like what you're. So in your house, what do? You try to find another house just like yours, with just as many bedrooms, lot size is the same, in the neighborhood you're in. But often you have to make compromises, right? Your neighbor, your backyard might be smaller, you have one less bedroom. But if you could find a perfectly identical asset and you know what it's priced at, you've hit nirvana. Odds are you will never find something like that in investing. So what do? You expand the search to come up with more companies that you claim are just like yours. I know it's a lie, you know it's a lie, but we go along, right? So you're pricing Microsoft, you pull up a list of 15 companies. Let me show you 15 companies just like Microsoft. What universe did you go to find these 15 companies? Or 12 companies like NVIDIA? You stretch the definition of identical, you call it a peer group, and you ask me to go along for the ride. You can already see that stock pricing is on much weaker ground than real estate pricing, right? I can find houses like yours. In what universe can I find a stock just like NVIDIA or just like Microsoft? But we try. The second problem is when you're comparing prices per share across companies, you're comparing something that's completely arbitrary. What's the most, if I define expensive as just stock prices high, what's the most expensive stock in the US? We talked about it. Berkshire Hathaway, I think it was 300,000, 400,000 per share. Try buying a round lot of Berkshire Hathaway. And if you can pull it off, I'd like to know who you are because you're going to pay for dinner for the entire class for the rest of the semester, right? And by the same token, a penny stock is cheap, right? It's trading at a penny. And you can already see that it's kind of meaningless. So what do? We divide the price by something. If I divide the price by earnings, I get a PE ratio. Price by book, I get a price to book ratio. Or I take the value of the firm and divide by EBIT. Whenever you see a multiple, EV to EBITDA, EV to sales, it's a standardized price. You can see why you stand. So you got your peer group with companies that are like mine but have differences. You got the standardized price, and then you get ready to spin your story about whether I should buy the stock. If you're careful, what do? You tell me that your company is higher growth or lower risk than the peer group, and you tell me to trade at a higher multiple. This is what every equity research report is, right? There's a multiple, there are comparables, and there's a story. That's what pricing is. And are you assuming that markets make mistakes with pricing? Yes, but a different kind of mistake. You're assuming actually markets are right on average when you price things because you're drawing your pricing from everything else, but you're assuming that they make mistakes on individual companies. Do you see the difference in assumption between this mistake and the mistake that drove intrinsic valuation? There you make a mistake, you correct it over time. Here the mistake is what's called cross-section. You're saying your stock is cheap relative to these other stocks, and you're hoping the correction happens. And in this case, I think the chances of a correction happening are greater and quicker than an intrinsic because it sticks out. If you have a steel company trading at 5 times earnings and everybody else trades at 15 times earnings, it sticks out like a sore thumb, right? More likely to be noticed. So pricing, you can get away with a much shorter time horizon. Yes. First, when you buy an index, you're not trying to beat the market, right? Nobody buys an index fund to beat the market. What do you buy an index fund to do? Match the market. If you want to beat the market and you're buying index funds, then I have questions about where it's driving you. So the very fact that you're buying an index fund already gives away the fact is I don't want to waste the time trying to beat the market. Nobody does it anyway. It's why it's called passive investing. Essentially, you're saying, I can't beat the market. I'm going to buy index funds and ETFs to get what I want, and then I'm going to go back and live the rest of my life. Actually, a much healthier lifestyle than agonizing about what stock to buy, what stock to sell, what to hold. Right? So that's pricing. Let's talk about the advantage of pricing. First, you're always going to be closer to the market when you price things. Why? Because that's how you're setting numbers. And for some people, that's a good thing. You're an equity mutual fund manager at Fidelity. You have to hold stocks. That's your job. If you come to me and say, I did intrinsic valuation, nothing looks cheap, I'm buying nothing, you're done, you're fired, right? Equity mutual fund manager, whether they like to not. What about an equity research analyst? I described at least partially what they do, right? They give you 15 companies and they say put buy and sell. Implicit there is a mission. Your mission is a pricing mission. I'm saying buy or sell. A buy in an equity research report doesn't mean the stock is undervalued. It just means that relative to the other 14 stocks that this person covers, this stock looks cheap. So in pricing, you're always going to be okay if that's your job, is to hold equities. Right? So there'll always be a portion of stocks that'll be underpriced. That doesn't have to be true with markets. Right? And general pricing requires a lot less work and a lot less information, which you're going to find when you price your stocks. Right? Because I'm going to make you do it after you've done the intrinsic valuation. Say, this was easy. So let's talk about the disadvantages. So you create a portfolio based on pricing. You find underpriced things. Even if you're right that they're underpriced, is it possible that your portfolio could be down 40%? Think of why. Underpriced basically means it's, you found, but let's say they're all overvalued. Stock, the entire sector drops. Yours drops only 30%. Everybody else drops by 50%. You were right about it being underpriced. It's a very different question you're asking. You're not saying, is this an undervalued company? You're saying, is it underpriced? So you could be right and end up holding this terrible portfolio. Second, pricing is built on the assumption the market is right on average. So don't you dare bring up market efficiency as something you're fighting, because you are buying into market efficiency, but in a very selective way. And finally, it is true you require less information, but one of the things I'm going to do when we talk about multiples, and I'm going to take each of them apart, is I'm going to argue that when you use a multiple, whether you like it or not, you're making assumptions about cash flows, growth, and risk, and I'm going to make those assumptions explicit. So you don't like making assumptions about cash flow, growth, and risk? You know, the only difference between intrinsic valuation and pricing is, in intrinsic valuation, you have to be explicit about those assumptions. In pricing, they're implicit. You pay 50 times revenues for a company. I don't care what you want to tell me. You're assuming high revenue growth. It is, where am I doing that? By paying 50 times revenues. So when does pricing work best? First, it works best when there are a large number of other assets that are at least like yours that are being priced. You know, fine art is priced, right? A Picasso is priced. But a Picasso is more difficult to price than a stock, and a stock is more difficult to price than real estate. Why? There aren't that many Picassos around being, not only do you need a lot of Picassos, but they need to be bought and sold, right? Collectibles are tough to price, not because we don't know how to price them, but because there's limited data. You have a baseball card, I can give you an estimate based on the last transaction, but the last transaction on a Mickey Mantle rookie card or a Ken Griffey Jr. rookie card was 3 years ago. It's kind of stale, but I try my best. Second, so you need large number of assets that are priced, and there's got to be something you can scale it to. The other reason Picassos are tough to price is, what do you scale it to? The size of the painting? I heard that the Mona Lisa got its own room in the Louvre. I was extremely unimpressed with the Mona Lisa, because you stand in like 2 hours, you go in, you're expecting this big painting, right? It's this tiny little thing on the wall. Say, this is what I waited 2 hours to do? No, the enigmatic smile, and this is like the emperor's new clothes. The smile looks really enigmatic. Then you go home and check up, what does enigmatic even mean? I have no idea, but I stood 2 hours. I've got to justify it. But you remember about a few years ago, another Van Gogh came up, and I think it was Saudi royal family bought the Van Gogh. It was priced at 450 million. I never use the word value when you're throwing these things around. What was it based on? God only knows. It was an ugly looking Mona Lisa. That's basically what it looked like to me, but I'm not an appraiser. So I don't know how you discount for the ugliness scale on a Mona Lisa pricing scale. But pricing is obviously more difficult when you're doing stuff like that. Who does it work for? First, short-time horizons are okay. So if you're a portfolio manager, much of portfolio managers is pricing. They screen for cheap stocks and they buy its pricing. It's nice if you're judged against other people who are doing the same thing. Do you see why? Because what did I say happens in pricing? If everything is overpriced, things fall. You're down 30%, but you know how you look like a hero? If everybody else in your grouping is down 40%, you say, I dropped only 30%. That's how mutual funds are ranked. You look at Morningstar rankings of mutual funds, they're not measured against the market, they're measured against other mutual fund managers in the same group. And remember, things can be underpriced or overpriced, right? So let's stay with the pricing game. Wouldn't it be nice if you could take advantage of both underpricing and overpricing? Most mutual funds cannot. Why? They're long only, right? A Fidelity Magellan fund can't go sell short. Most mutual funds are restricted from shorting. They have to be long only. So who can go on both halves, underpriced and overpriced? A hedge fund, if it's truly a hedge fund, this is what you get in addition to being, you can go short. A hedge fund run right can take advantage of both sides and hope that way, even if the market is wrong and there's a full correction, you're going to be okay because you're betting on convergence. So if you go to work for a hedge fund, don't even talk about intrinsic value. It really has no play in this game. It's a pricing game. You talk about quant hedge funds, they're just looking for better ways of pricing and better ways of forecasting corrections in pricing. So I actually, in response to can Bitcoin be valued, I actually decided to write a piece on Bitcoin. Is it a currency? Is it a collectible? Is it an asset? I've kind of given away the game, right? Basically, you can look across things. There are some things that can be both valued and priced. A stock, a bond, okay, because it has cash flows. A commodity generally can only be priced. If you ask me, what is an intrinsic value for oil? I have no idea. I could build some macro model where I look at the demand for oil and the supply. People have tried it. Models work terribly because there are all kinds of things you don't control. Most commodities are priced. What happens if you have a currency? Well, currency can only be priced. That's what an exchange rate is. So if you're a good currency, you should have a higher, your exchange rate should get better against bad currencies. So I'm going to pick on any believers in Bitcoin. I want to put you on the spot here. Nobody wants to admit to being a believer. Oh, come on, it's $100,000 now. Think of. You want to be a believer? Okay, let's play along, right? So the question I would ask with $100,000 is Bitcoin a good currency? Which then means I have to define what a good currency is. So what is a good currency? What is it? What do you do with it? Before you get any further, why do you put $20 in your pocket or carrying your Apple Card? Because you got to buy lunch. First thing with the currency is, remember, you have to you have to transact with it. So good currency is a medium of exchange. So the second is it holds its value, right? That's it. So the Swiss franc is a really good currency. And what dimensions? First, clearly in Switzerland, I can use it to pay for stuff. But if I leave Switzerland and I come to the US with Swiss francs in my pocket, I can go into a bank and get it converted into US dollars. So basically it's convertible. And if I put 100 Swiss francs, which I actually did a few years ago, into a pocket of my dress pants, I almost never wear dress pants because I wear jeans most of the time. A year later, I went to put the dress pants, or put my hand in my pocket, there's 100 Swiss francs. And I was happened to be in Switzerland. And you know what? I was able to buy about the same things that I could have bought a year ago. It held its value. Low inflation, even a deflationary currency. Swiss franc is a really good currency. The Indian rupee, it's a currency inside India. But God help you if you put 10,000 rupees in your pocket and you go to New York, you walk into New York Bank and said, can I convert 10,000 rupees? It's not freely convertible. And if you leave 1,000 rupees in your pocket for a year, you will buy less than you did last year because there is inflation, 4, 5, 6%. But before you complain about the Indian rupee, think about holding Venezuelan bolivar. It's a horrifically bad currency, right? Even in Venezuela, people, you'd pay for lettuce. They say, can you pay with something else other than currency? Because by the time it hits my hand, it's worth half what it was before you paid for it. And God help you if you put 1,000 or 10,000 bolivar in your pocket and forget about it for a year. You might as well use it as toilet paper, and it's not even very good toilet paper. It's a horrific. So even within fiat currency. So where in that spectrum between the Swiss franc and the Venezuelan bolivar would you put Bitcoin? We rephrase the question. When was the last time anybody in this room used Bitcoin on a transaction? Not did you trade it. Anybody here? Did you use Bitcoin? Where did you use it? 7 fake IDs. Okay, there's a niche market out there, right? The Silk Road in fake IDs. So there's a niche market. Maybe use Bitcoin in places where you want to hide your transactions and nobody can trace it. I'm glad you brought that up because I asked this question because sometimes I am asked to talk to these rooms of Bitcoin believers. I don't know why they keep asking me back. And I say, how many, and this is a room, everybody claims, and most of the people in the room have never ever used Bitcoin in a transaction. And why? What holds you back? Let's say I went into Starbucks, ordered a venti cappuccino. What does it cost like in New York? They have a premium price, probably like $6. I tried to pay with Bitcoin. First, they don't take it, but let's say they did. Let's see what happens next, right? Remember, Bitcoin is not in your pocket, it's not in your wallet, it's in this digital whatever. Nobody knows whether you have it. So what has to happen for this to leave my pocket and go into the Starbucks Bitcoin wallet? A Ukrainian miner has to get on a computer and guess a 9-digit number. Comes up with this convoluted way of doing things. But that's what paranoia will get you. Bitcoin was born in paranoia. You can trust no one. It's an incredibly inefficient currency. So I judge it as a currency. It's not a very good currency. So why would I convert it, $100,000 for one Bitcoin? Where am I going to use it? The other pitch for Bitcoin is it's a collectible. What's the most famous and long-standing collectible of all time? Gold. How long has gold been around? It predates currencies. What makes it special? Why did they pick gold as opposed to one of the other elements? You can mold it into different things, right? So that's the first thing. The other is also it's almost indestructible. It melts and comes back. It's almost it doesn't rust. So basically, there were reasons they picked gold, but whatever it is, it's become embedded as. And for a long time, when people lost faith in paper currencies, what did they do? They bought gold. At one point in time, I think a third of all the gold in the world was in India. Because that's what Indians use. They didn't buy real estate, they didn't buy stocks, they bought gold. I describe Bitcoin as millennial gold. Why do you do it? Because you're 25 years old, you don't want to look old. And you know that when your parents panic, they bought gold, and you don't want to be like your parents, so you buy Bitcoin instead. Right? I understand. It's millennial gold. And the question is it a good collectible? What makes for a good collectible? Staying power, right? There was a time when Beanie Babies were collectibles. There were people actually used to buy Beanie Babies in bulk, put in. I think they moved out of the house and filled the house with Beanie Babies because this was going to be their pension. They're probably homeless right now. Because Beanie Babies lost their value. It was a collectible until it wasn't because it was a fad. And with Bitcoin, you're saying it's been around 15 years. 15 years is not, gold has been around 4,000 years. Is it a good collectible? Year 2 test run. Good collectible is not just scarce. Scarcity is just part of the game because Bitcoin is scarce because you can only 21. But also it holds its value during crises. And Bitcoin fails on that test every single time. Every time we've had a crisis in the last 16 years, stocks go down 30%, guess what Bitcoin does? It goes down 50%. Stocks go up 30%. It behaves like very risky stock. So if you have a Bitcoin enthusiast in your family, you know the person I'm talking about, you try to not invite that person to Thanksgiving, but he shows up anyway. Ask him the question, what are you buying? Is it a currency? Is it a collectible? And if it's a currency, it's a bad currency. It's a collectible. It's not a very good collectible. What are you paying the 100,000 for? And the honest answer is, I have no idea. I just think I can sell it to somebody else at 120,000, which is fine. At least we got the honest answer out. So as you look at pricing, remember there are some things that cannot be valued. They can only be priced. Along the way, we're going to take a detour and talk about valuing a company assets, businesses in separately. You're saying, why would I do that? Because it's called sum of the parts valuation. Rather than value the company, you value in pieces. Like what? I can take Coca-Cola and value each geography that Coca-Cola is in separately, add it all up. I can take a multi-business company and value each business separately. So I can take, let's take Microsoft. I can take the Windows Office part of the business, value it. I can take the cloud, the Azure part of the business, which now is about half of Microsoft's revenues, and value it. And then I can take the AI part and value it. Maybe less valuable than last Friday, and add them up. The techniques I'm going to use are the same, but it requires more information because you now need information in the piece. We'll talk about when investors might want to do that, especially if they're investors who want to break up companies for their value. But it's not a different way of approaching valuation, just a detour. So I'm going to ask you a question, and this question is going to show up in the very last class as well. Right now, many of you have never probably fully valued a company. You might not even have priced a company, but based on this very preliminary description of what you do, I want you to pick, if you had to pick, which of these approaches you would hang your hat on. It's not conclusive because obviously after you value price a company, I'm going to ask you the question, are you still sticking with that choice? But make this choice. There's no right answer. Make a choice and save it. And in the last week of class, I'm going to ask you the same question. I want you to think about why your views might change. Now, as I said, there is this side story where sometimes a business or an asset gets its cash flows, but the cash flows are contingent on something happening. I know you've probably done options in foundations, right? Even if you haven't, options have some very unique features. First is they're leeches. They derive their value from something else. An option can't live on its own. There's got to be an underlying asset. And the cash flows are contingent on something happening. The way this shows up is in a payoff diagram. So if you see options, the payoff diagram is fairly unique. And as you look at this payoff diagram, it'll give you some insight into why classifying something as an option changes your perspective on it. If you have a call option, you're betting on stock, a price going up. If the price goes up, you collect the money. But if it doesn't, you lose what you paid for the call option. If you have a put option, you're betting on prices going down. And if that happens, you make a lot of money. If you don't, you lose what you paid. Keyword is, if you lose what you paid. You've limited losses and potentially unlimited profits. You know what that does? It makes risk your ally when you invest in options. In what sense? When we talk about risk, are you guys more worried about downside risk or upside risk? Do any of you lie awake and say, I'm really scared my stock might double? I don't think anybody stays awake at night saying my stock might double. They're worried about the risk you worry about is downside risk, right? And what have I done in an option? I put a limit on what you, so with options, the minute you think of an asset as an option, you want high risk, right? So we're going to talk about options, and there are listed options. We're going to spend no time in this space. There's an options class. You can do warrants and options and convertible bonds. This class, the options I'm going to talk about are business options. I'm going to argue that if you have equity in a deeply troubled firm, what does a deeply troubled firm do? Walk on the street, mutter to itself, that's part of it. But deeply troubled firms have negative earnings, have a lot of debt, and you have equity in the firm. You say, why would I have equity? Maybe you got there by accident. This firm did not used to be a troubled firm. You bought when it was a healthy firm. Now it's become deeply troubled. I'm going to argue that this equity is really more like an option. Why? You're underwater anyway. What difference does it make whether you drown in 10 feet or 30 feet, right? At this stage, you're saying, give me risk. Maybe that'll bring me back. So we're going to talk about equity in deeply troubled firms. We're also going to talk about natural resource companies, oil companies. Where does the optionality come from? When you value a natural resource company, you take existing prices, you bring them in, you do the right things. But the thing you don't control is that price can change. So you can have a company whose reserves are not viable today, but could become viable. You have an option. Every oil company with a discounted cash flow model is going to be undervalued because you're not capturing the optionality. We're going to talk about how to capture that optionality. If you're a technology company and own a patent, the patent is not viable today. And ask you, will you give me that patent? Your first response, what? Nothing. Well, you take it. Be very careful because it has an exclusive right, and that exclusive right could become valuable. You hold on to an option. So we're going to talk about real options. That's what these are as we go through the class towards the second half of the class. But the advantage of option pricing is now you can put a number on things you give up on, right? Many deeply troubled companies, you try valuing with an intrinsic valuation, you conclude the equity is worth nothing. You try pricing, the equity is worth nothing. But people are paying for the equity. So why are they doing it? Only way you can get there is with an option pricing model. And more than anything else, even if you never put a number on an option, just recognizing when something becomes an option changes the way you think about risk. So that's the advantage. The disadvantage is many of the option pricing models we have, and you might have seen the Black-Scholes model. I won't ask you, do you remember the Black-Scholes model? But you've seen it, right? The model that flashed by, making you use all those unusable buttons on your calculator. E to the X, log X, all of those showed up. That's why we do the Black-Scholes, is to make you use those buttons. Okay? Those models were built for short-term options on traded stocks. We're going to use those models to value a patent. You're now talking about a 15-year option on something that's not traded. You're going to be bending and breaking those rules. So I'm not going to tell you these option pricing models work really well because they're going to get stretched. Right? And to the extent that you get your value from an underlying asset, that underlying asset, if we can't get a price, getting the option value is going to be difficult. What's the underlying asset in a patent? That you can develop it into a commercial product and get cash flows on it, right? It's not traded out there. You got to estimate layers of estimation on top of other layers of estimation. So I want you to keep that perspective. Intrinsic valuation, pricing, options, everything falls into those three buckets. And for the moment, don't shut off any doors. Don't say, I will never do pricing. I'm a value person. I price companies all the time. I make my decisions based on value, but I still price them. Why? Because I live in a pricing world. I need to understand how traders think because that's how I make money. Is the traders change their mind. It behooves you, even if you're a true believer in one or the other, to understand how the other approaches work. So I'm going to start on the first valuation packet and at least let's get the process rolling. So this packet is going to take us almost halfway through this class. It's going to be the intrinsic value packet. And again, at the risk of repeating myself, if you think about the essence of intrinsic value, the present value, the expected cash flows, right? You need expected cash flows, you need discount rate. So in intrinsic valuation, you're trying to come up with the present value of the cash flows and saying that's my intrinsic value. This is not high-level math. It's an equation. And in fact, there are two forms you will see for the equation. The first form is the one that you see in class. I'm going to give you a second variation that you might not see that's completely okay. And we'll talk about why it doesn't show up as much. In the first one, here's what you do. You estimate the expected cash flows on the asset. What is it required to think about? All the possible scenarios. You work them through. You come up with the expected cash flows. Expected. And you discount those expected cash flows at a risk-adjusted discount rate. So how do we measure for risk? That'll come. These are the details. Expected cash. That's your first version. There's a second version. The second version, rather than use expected cash flows, use what are called certainty equivalent cash flows. So what the heck are those? You seen this TV show, Let's Make a Deal with Howie Mandel? I watch a lot of crap TV. This happens to be one of the shows I watch. And here's how the show works, right? You're a contestant. It's a game show. So there'll be suitcases up. So imagine you're seeing suitcases, and suitcases will have different amounts of money. Let's make this game really simple. There's two suitcases, one with $1 million and one with nothing in it. You don't know which one is which. And you come up to the front. So you're going to be, you want to be, Yara, you're going to be my contestant. I'm going to be Howie Mandel. So $1 million in one suitcase, zero. What is the expected value if you're purely statistically? Half of that, 500,000. Here's how the game works. I offer you cash instead of taking that offer. So if I offered you 200,000, would you be willing to take the cash and not make that bet? It's a question, right? If you're risk averse, you might say, I'll take 200,000. As you get closer and closer to 500,000, you're telling me whether if you're risk neutral, you'll say, I want 500,000. But the truth is that there's risk here. You might not get the $1 million suitcase. If you watch Let's Make a Deal, you're watching certainty equivalence, sir, because the contestant will say, I'll take 400,000. They took a certainty equivalent, $400,000 in the pocket instead of taking this gamble. Say, how the heck am I going to use this in valuing companies? I come to you with the expected cash flows in Coca-Cola, and I'll be Howie Mandel and say, if I could give you guaranteed cash flows instead of these expected cash flows, what would you want? And you say, no, I'll take a haircut on these, 10%. How much of a haircut will depend on how risk averse you are. And once you've done that, you've got certainty equivalent cash flows. And once you do that, remember, you've adjusted the cash flows now for the risk. Guess what you discount them back at? Yara? If I cash flows are adjust for risk, I no longer have to adjust my discount rate for risk. I can discount them at the risk-free rate. One of my problems in this class is people who listen sometimes to what Warren Buffett says and act like it's religious theology, right? And one of the things that Warren Buffett has supposedly said, Warren Buffett is like Confucius. You can say whatever you want. Confucius said that. He seems to have said a lot of things, like Yogi Berra said that. Really? Do you know? I mean, when did he have time to talk and say all these things? But supposedly Buffett has said that he doesn't adjust the discount rate for risk, that he uses a risk-free rate. And people here that come into my class and say, Warren Buffett uses the risk-free rate. Why are you using this beta and risk-adjusted discount rate? What's the answer to that? I mean, let's say he does use the risk-free rate. What does he have in the numerator? He doesn't have expected cash flows. He has what he calls cash flows you can count on, which is a way of saying I'm going to count only the cash flows I feel sure about, and I'm not going to give you the extra benefit for speculative cash flows. He's, in a sense, using certainty equivalence without ever trying to do any full adjustment, but it's be careful that you don't end up doing that and using a risk-adjusted discount rate. So if you're an analyst and you start using conservative, it drives me crazy when analysts say, I'm going to use conservative estimates of the earnings. No. Do your expected estimates and do the risk, because if you use conservative estimates and then you use the risk-adjusted discount rate, you're double counting risk. Pick your battles, right? So I'm going to start with what I call my core page on intrinsic valuation. As you know, I do value companies, I write about them in my blog, and then I hear from a lot of people. And I won't say what I hear, but some of it is things I'd prefer not to hear. But usually it's people who disagree with you. I've discovered in social media, people who disagree with you are more likely to speak up than people who agree with you. So I get that as part of the, so I post, my NVIDIA valuation next Tuesday, and I can almost promise you that within 24 hours, I'm going to get a couple of thousand people saying, you're wrong. And I say, okay, it's my money. I'll be wrong with my money. You be wrong with your own money. So why are you picking on me? But once in a while, there'll be people who won't even say you're wrong. They'll just go to the insult phase right off. They skip this whole thing. And their favorite insult is, you academic. Don't ever take that as a compliment. You know what the subtext there is, right? You're an academic. You work in the theory space. You're a theorist. And I have to laugh because I know how little theory there is in this class. You want to see the theory? There it is. That's the theory for the class. One stupid equation. But it's an insanely powerful starting point. I forgot to bring what I was supposed to, but let's play this game anyway. Right? I might have some money in my pocket. So crumpled up. I have a $5 bill right here, right? I have to make up an envelope. Oh, no, I actually brought it. Let's play the game the way it was meant to be played. So let me up the ante. So I want somebody to be my guinea pig. You want to be my guinea pig? I'll make you look good, don't worry, okay? So here's what I'm going to do. I have a $20 bill. Tell the class that there's nothing in the envelope, right? I'm going to put it in there. My sleeves are rolled up. I'm not a magician. I'm not going to pull it. How much did you pay for this envelope? Don't think too long. Get you to trouble. I'm glad he said $5. You know the answer I usually get is, right? What were you, tell me honestly, what were you thinking of saying you'd pay? What did you see me put in the envelope? $20, right? Most of the time, the answer I get is $20. And if you pay $20 for an envelope with $20, what do you end up with? An envelope, which I stole from somewhere and I've written all over. Cost me absolutely nothing. I steal it from the school reserves all the time. But you're right. You want to start your bid. The first rule in valuation, you know the value of something, start your bidding at a lower number. If you have trouble thinking lower or higher, then you have a future as a banker, but not a future as an investor. But this is an easy asset to value, right? At the end of this auction, if I had one, we're going to end up at 20. So let's say we're at $20. And now I'm going to let you hold this neat stuff, and I'll take it back. Don't worry. Yeah. I'm going to show you cards, and I want you to read to the class, Yara. What does it say? Okay, it says control. I'm going to put it in the envelope with the $20. Trouble getting the envelope open. It's getting ripping, so that's okay. It's somebody else's envelope anyway. So you ready? Remember the value was $20 before the card was put in. Now it is $20 plus control. How much did you pay for this envelope now? She has no future as a banker. You know why I put the word control, right? If any of you worked in M&A, when you value a target company, you know what you're hard-coded to do in M&A? Is to add a 20% control premium. I actually tried this at Goldman Sachs for their established M&A people. They were coming back for a re-education camp, I think. They asked me to talk to them. I did this, and Goldman Sachs banker decides he's going to be clever. And he offers me $25. You know what I did? I sold him the envelope. In which case, what did he do? He paid $5 for a 3x5 card with the word control on it. You know how much it cost me to put this together? Maybe 3 cents. He said, but I didn't mean it. I said, now that it's your own money, you feel the pain, right? Control. So we're on our way here. So I put control in. Let's keep going. What does this say? Synergy magic. Okay, let's put that in. Still $20 plus 2 cards, control and synergy. Can't stop right now. What does this say? Brand name. Or marketing persons are doing somersaults, their brand name in there as well. Right? And since we're doing this, what does it say? AI. Okay, I'll put that in as well. Less valuable than last week, but it's in there. And I could go to town, you know. What does it say? But before I did that, I first had a China that I crossed out, and then I put an India. For 20 years in valuation circles, you were trying to value a company and the number was not budging. All you had to throw into the conversation is, but we're going to be in China. Why? 1 billion people, low people. I mean, they don't even know what to do with 1 billion people. The only problem is that China's not working as well for lots of different reasons. So now it's India. Let's face it, much as we like to dress up the India story, its strongest suit is not great governments and amazing. It's 1 billion plus people. It's tough to replicate it. Impossible if you're Europe, you're not even going to get there. I call these weapons of mass distraction. Why? Because they show up after you've done the numbers, right? You value the company. You say, but what about control? What about synergy? What about AI? What about brand name? What about great management? What about China? What about India? What about all of it? So here's my first proposition. It's called the IT proposition. If it does not affect the cash flows and it does not affect risk, can we please stop talking about it? Let's go back. What's the value of control? Okay. Anybody want to try? What's the value of controlling a company? What do you think the value of controlling a company is? You run the company, so the existing guys, right? I'm laying the foundation. Could you run the company differently maybe? Maybe better? Maybe you don't like the way the company's run. The value of control comes from the fact that you think you can run a company better than the existing management can. You see the foundation. We're going to value control later in the class. When the value control, we're going to value twice. Once with the status quo and once with you in place as the management. And if your plans come to fruition, I would expect your value to be higher. That is the value of control. You see the implication of this. If you're buying a company that's already perfectly managed and perfectly run, what should the value of control be? Zero. If you're buying a company that's terribly run, awful management, value control could be 100%. So can control a value? Yes, not 20%, like the banker puts it. What's the value of synergy? What is synergy? Please don't give me the 2 plus 2 is 5 crap that sometimes kind. It's not. 2 plus 2 is 4, right? You know, you can't dress it up. It's the two entities coming together are able to do something they could not have done as standalone entities. Can I value synergy? I better be able to, otherwise I can't pay for it. Later in this class, I'm going to take the InBev SAB Miller merger. This is one of the great big brewers, the largest brewer in the world, and we're going to value synergy. But we're going to do it the right way by estimating the cash flows, the growth, and the risk. What's the value of AI? What is the value of AI to NVIDIA? It sells chips to build the architecture. It's the only company where there's a tangible cash flow. What is the value to Microsoft? Already the hand waving has to begin, right? It might be that they can charge a LinkedIn AI subscription that's higher than a LinkedIn subscription. We don't know. Let's not let people use buzzwords. And in many ways, what DeepSeek did was healthy because there was a lot of buzziness about AI. People paid premiums. Why? It's AI. And I've said some terrible things about ESG, and I don't take any of them back. In fact, I'll give you my priors in ESG. And when I asked to describe what I think about ESG, I said, this is an acronym born in sanctimony, nurtured with hypocrisy, and sold with sophistry. And I will leave it at that. You can see, you can go online, check my. But the reason I am so skeptical about ESG is in 2019, I looked at ESG because I was curious. Larry Fink keeps telling me, Larry Fink, of course, is BlackRock's CEO, that ESG is good for value. I said, okay, if it's good for value, it might either show up in the cash flows or it must show up in the risk. So I went item by item. Does it increase my growth rate? No. Does it improve my margins? It actually decreases it. Does it mean I can reinvest less? No, I still have to build the same factories. Does it make me less risky? Not really. So why are we talking about it? Because lots of people are making money. This is a great bullshit detector. It's to bring the it proposition. Next time you hear somebody throw something buzzy into a conversation, sustainability, ESG, whatever it is, push back. Sustainable of what? Where does it show up? That's the it proposition. Second proposition is don't be a wuss proposition. What does that require? About 2 weeks into this class, you're going to sit down to do evaluation, say, this requires me to look into the future. Yeah, that's it. I might be wrong. That's okay. You can't let that stop you. Fight through those impulses because it's natural to be worried about being wrong, but you have to be okay. The third proposition I call the DER proposition. It's named after my daughter, who's now 30 and came about when she was in her teens. We used to have family dinners. All 4 of my kids were still at home. We'd have family dinners. I had the distinct misfortune of sitting across the table from my daughter. So a topical conversation would come up, but I thought I had something useful to add. I'd open my mouth and my daughter would look across the table and say, Dad, duh. The amount of contempt that oozed out of the duh was such that I stopped talking for a couple of years. The duh proposition is for a special subset of questions I get about valuing companies. Here's how the email will go. I'm valuing a money-losing company. I expect it to lose money forever. What discounted cash flow model do you think I can use to get a value for the company? You feel like slapping the person around the face and wake up. You have a money-losing company, you expect to lose money forever. Let's get this out of the way. How much should you pay for the company? They should pay you, right? You have a company with a bad business model. You can't get blood out of a stone. What's a bad business model? It's a good way to end today's class. Most of you are too young to have been potential customers for this business called Movie Pass. You've heard of it? It's about 10 years ago. It's a subscription business where you paid $9.99 to Movie Pass, and in return, you could watch as many movies as you wanted in whichever theater you wanted. How much does a movie cost in New York City now? 20, 14? I'd love to see where the theater is, right? It's usually 20, or you $9.99 a month. You could watch 10 movies. And Movie Pass would put, I remember looking and saying, this is the stupidest business model I've ever seen. How do they get away with it? And then I saw the CEO of the company show up on CNBC. And then I realized how stupid people can be and get to the top of an organization. And this is how he justified the model. He said, we charge $9.99. And he said the average American goes to one movie a month, and the average movie ticket price is $7.50. We're actually making $2.49 a subscription. What's the problem with this logic? It's a self-selection, not the average American. It's not people like, you know how many movies my son saw last month? 23 movies. He works at Disney. He claims this is his job. Okay? 23 movies. He had Movie Pass. He was bankrupting them single-handed. So if you have a bad business, walk away from it. So next session, we're going to dig into risk-free rates and risk premiums. So I will leave you there.